How you doing, Discover Your Options students? You're back with Coach Jay Johnson, and we're on another page with inside of the guide. This is the options, what and why. So this is pretty simple. We're just going to run through the material on this here particular page, and hopefully it'll give you a little bit better understanding of what options are and why you want to consider them. So we'll get right into it. So right here, I'm going to start reading. So what's all the hype about options and what role can they play in establishing generational wealth? Again, this is the wealth that's being passed down to your children and grandchildren. We are currently not in position where we're positioning ourselves correctly to pass down any wealth to our children and grandchildren. And options can be one tool used to help you start that journey. The reality is that most people don't have an extra 5K sitting around. I know when I first got into options, I have money sitting around, but I really didn't want to spend it on no options or on no stocks. I really was clutching it really tight because it was pretty much some of my last bit of money. And most people that enter the market that are new to the market, with the exception of a few, but majority of people, they just don't have that type of money laying around to dump into the equity markets. And if they do, it's not disposable money, which is where I was at. I had it, but it wasn't disposable. That they would be comfortable using to buy stock in blue chip or centenarian companies. A centenarian company is a company that's been around for over 100 years, for instance, like a Walmart or something, or Sears. They put in their work. So what options do you have? Our answer is options may be your option. Stock options allow you to control 100 shares of a publicly traded company for a premium. We know this. I say it in every video. I reiterate it. One contract equals 100 shares, and there's a premium attached to that contract for you to control those 100 shares. A premium is simply the fee you pay for the right to manage a contract, which is 100 shares of a particular company during a given period of time. This premium or fee is often a fraction of the cost of the actual share. And that's going to be always the case. It's going to be a fraction of what it costs to actually buy 100 shares. So really, this shouldn't say often. It's going to always be a fraction of the cost. And it's the only upfront cost required to control this stock. So there's no other money required to control those 100 shares. Options are all about trends. At least that's how Discover Your Options has figured out how to be so successful. We were able to minimize risk and we were able to locate trends. In the most simple terms, you are predicting what the share price will be on some future date that you select. That estimated future price becomes your strike price. We've broken down option chains. We've broken down expiration dates. So these things should really start to make sense to you. The more likely your strike price is of becoming the share price, the higher your premium will rise. So if you have company A trading for $10 and we're going to predict that it's going to get to $20 by some future date, as that current share price moves from 10 to 11, 12, 13, closer to that $20 strike price, your premium goes up. That's how this works in a nutshell. The more likely your strike price is of becoming the share price, so the more likely that company A's $10 current share price is of becoming $20, the higher your premium will rise. The more unlikely in a call scenario, the more the premium will drop. Actually, in a call or put scenario. No, in a call scenario. In a put scenario, you want your share price to go in the opposite direction of your strike price. That's how your premium moves on a put. On a call, you want your share price to move as close as possible and hopefully surpass your strike price. If you allow your contract to expire without selling it or executing your right to buy the shares, you will only be out your premium. So for company A that's trading for $10 and we have this $20 strike price for, let's say, November 16th, if we don't either buy the 100 shares, which Discover Your Options never has an intent to do, or if you don't execute or sell that contract and that expiration date in November hits, you will be out your premium. Whatever your premium costs for that contract, you will lose that. You can't get it back. This will help you to mitigate your risk of loss. So again, there's a video. Don't know the order that these videos are put up on the platform, but we did a video where we're breaking down the advantages of buying an option versus stock. And then in that video, we showed where 100 shares of MTN, which is Vail Resort, I believe it was like $18,000. So I mean, $18,000 versus a $4 premium, which is $400. That's how you're mitigating your risk right there. If, however, you properly estimated the direction the stock would take during your contract period, you can turn around and sell your option contract to another interested party before it expires. And that's exactly what we do. So in another video, we break down the option chain and we spoke about volume and open interest and why it was important to have volume in your option contract that you're purchasing. Because what we're doing is we discover your options. We set our expiration dates like 6 months out, even further from the date that we bought it. So, because what we're trying to do is we're trying to have that premium rise, get our money, and be able to get out of it before the expiration date. So for that to happen, you need to give the next option trader time to look at your option and believe that they can either execute it and buy the shares, or that they can make a little money themselves before that expiration date. So you want to make sure you have a good time horizon and be able to give the person the trader that's going to purchase your contract time to buy it and get rid of it themselves. Your net profit will be the difference between what you paid for the premium and the premium at the time you sold your contract. Real simple. Your net profit is whatever you paid for in the beginning minus what you sold it for. If you paid $2 in the beginning and you sold it for $8, your net profit is going to be $600. The net profit allows you to slowly build up available cash. Do not start taking money out of your brokerage the minute you start making money. The object of this here for this boot camp is for you to not touch it. That's why I told everybody that when you put it in there, just forget about it. It's gone. Because what you're going to do is with each trade that you're successful at, that return is just going to be reinvested in either the same company or a different company option contract. So we're going to continue to flip that return. So if you're fortunate enough to be getting 100% returns, I mean, the math is pretty simple. So you're taking 500 to 1,000, 1,000 to 2, 2 to 4. This is how it works. Leave your cash in there. We're trying to build this thing up so you can give yourself a little bit more time to do the things you want to do in life. But that's what this page is all about. Just a quick rundown on what options are and what's all the hype about. because there's a lot of hype behind options. Hope that helped you out. If you have any questions about it, please reach out to either myself or Coach Jackie Johnson, and we'll be happy to talk to you about it. Thank you very much. I'll see you guys in the next video.